Hello, everyone, and welcome again to Wealth Matters for Physicians by Altfest Personal Wealth Management. I'm Mike Prendergast, a director of Altfest's Healthcare Practice Group and the host of this channel, which provides key investing and financial planning insights to help physicians achieve their important life and financial goals. In this video, my colleague Ryan Graham and I will discuss some smart financial moves that physicians can make in a down market. As you know, due to the volatility of the financial markets this year, prices of most stocks and bonds are noticeably down. Today we'll discuss strategies like Roth conversions, tax loss harvesting, and gifting assets and how they can be financially advantageous to execute in down markets to help you strengthen your finances regardless of market conditions. Ryan will also answer one or two questions from our physician audience. Before I introduce Ryan, a few words about Altfest. For nearly 40 years, Altfest Personal Wealth Management has been helping physicians holistically optimize all areas of their personal financial lives in a fully objective, fee-transparent manner, while as a fiduciary, always putting their best interests first. We are honored to be the preferred wealth manager for members of the Medical Society of the State of New York, the preferred wealth management education provider of both the New York chapter of American College of Surgeons and the New York State Society of Orthopedic Surgeons, and a corporate partner of the Medical Society of the State of New Jersey, amongst other associations. Our guest today is my colleague, Ryan Graham. Ryan is a senior financial advisor here at Altfest Personal Wealth Management, where he works with physicians and their families develop and implement financial plans designed to achieve their personal and financial goals. In addition, Ryan serves on Altfest's Financial Planning Committee and has expertise in long-term care insurance. This is the second of two videos with Ryan Graham on smart moves physicians can make in a down market. Now going to another bucket of strategies, which is gifting assets gifting assets when they're temporarily down. So just on an overview level, because we'll have one or two more questions to follow up, why is it a good idea in general to gift assets when they're down?
Yeah, I think we could easily, we could both probably have a conversation for an hour on this, right, Mike, with how complex, gifting and estate planning can get when you're trying to get assets out of your estate. But I guess the very basics of this is, if something is lower in value, you can gift that away, if that's your intent, to reduce the size of your estate. If you're in a position where you're growing wealth very quickly, or maybe you're already at a point where you have substantial wealth, we're talking, a few $1 million, or at the New York state level, you start paying estate taxes at the $6 million threshold. So that's just to give you a sense of what kind of assets we're talking about. The idea of gifting those at lower values is important because you actually use up that estate tax exemption, that $6 million threshold for New York State. It's around $12 million for the federal level. But every time you gift more than $15,000, you start inching away and reducing that estate tax exemption. So doing that when assets are lower in value provides you more bang for your buck, similar to how we talked about doing a Roth conversion when assets are lower provides more bang for your buck. A similar mindset applies here. Getting those assets out of your estate, maybe they're quality assets that you expect to grow over time, put those somewhere else so that you're not having to pay estate taxes on these assets, which, when we're talking federal estate taxes and state, like New York State estate taxes, these numbers can be quite large. We're talking maybe even 50% or more that you'd have to pay at the end of your life if you're subject to estate tax.
Excellent. Yes, and I know that, this makes me, I think because we both enjoy this type of work so much, but this makes me really excited because, you've got this federal estate tax exemption and it's a finite amount. But when assets are temporarily down, like you said, you'll be able to transfer more of these units of whatever investment it is out of your estate because you're still transferring the same number of units, whether it's 20 shares or 50 shares, but their dollar value has compressed down temporarily. And so I like to think of it as kind of like a spring. So it's compressed down And then once you get it in the tax-free vehicle, like either out of your estate or in the Roth IRA, it has the chance over time to spring back up to either what it was, its true value, or growing over time. So being able to get out all that growth out of your estate, out of the purview of the estate tax collectors, sounds very appealing to me.
And that's a great visual with that spring. And, you know, maybe this estate tax exemption that we're talking about, which is a very high figure now, maybe that changes in the future too. So being able to use it up while it's still very large can be valuable. You know, if we get some law changes that make that a much smaller figure, you know, it might not be $12 million in the future. So the ability to use it now can be pretty valuable.
That's a great point. That's a great point. I know last year that there was talk of lowering it down to, instead of on the federal level, about 12 million, maybe to 6 million. There was even some, even more talk by certain politicians like Bernie Sanders proposed some legislation to reduce the federal estate exemption to 3 million.
Yep.
So, I mean, that's not likely to happen, but it just goes to show you that you're right. You might want to use something good while you can, because there is a chance it could go away.
Exactly.
Moving to the next part of this on, you know, gifting assets, you know, we hear all the time, I'm sure our physicians hear all the time about, you know, another good vehicle to donate to charity while also getting some income for yourself, whether it's a charitable lead trust or a charitable remainder trust. And again, these might be something that our physician audience are kind of relatively familiar with on an overview level, but not really sure how these things work. Could you kind of explain how charitable lead and charitable remainder trusts work for us?
Absolutely. And I think, as with most things, like a visual can be pretty helpful here. So I'm just going to share my screen briefly. So you can see here on the left side, or top left, we have a charitable lead trust diagram, and then the bottom right, a charitable remainder trust diagram. And before I briefly overview the mechanics of those, once again, this strategy can be used, I guess, number one, as a tax strategy. And then number two, you're accomplishing charitable giving goals. So especially recently, we've had a lot of conversations around Ukraine and trying to, help as best you can. There's a lot of good organizations doing great work there. And, this is a type of strategy or other charitable giving strategies that can help you gift, money and assets to help with any efforts there, or even locally, to your favorite charity. So in this case, a trust-related strategy involves at the outset giving assets to a trust in either of these options. That is happening. At the same time, you're also getting a tax deduction in both of these strategies. That is also occurring. The key difference between these two strategies, as Mike and I know, are that in the remainder trust, after you make that initial gift, you or beneficiaries you identify are collecting income along the way from the trust. And then at the very end, the remainder goes to charity. And that's the opposite in a lead trust. At the beginning, you're actually giving charity, money every year, or whatever predefined period you choose. If it's a 10-year period, a 20-year period, if it's for your lifetime, your charity of choice is getting money every year from the trust. And then at the very end, you identify beneficiaries that get the remainder. So it certainly, the structure can depend on what your goals are, but also interest rates actually play into the structure too. And we all know and have seen in the news that there are higher interest rates now than there were just a few months ago, as inflation has creeped higher and the Federal Reserve has raised interest rates. And the remainder trust actually becomes a more attractive strategy as interest rates go higher. And the reason being is that your income tax deduction for any gift into the trust goes higher as interest rates go higher. And the reverse is true for the lead trust. It actually becomes less attractive as interest rates go higher because the tax deduction is lower. And we don't have to get into the weeds on why that is, but it's just something to consider if you've ever thought about either of these strategies.
Yes, thank you so much, Ryan. That was very, very helpful. I think definitely a picture is often worth 1,000 words. Not to discount your words. I thought your words were really great, but the picture is excellent. Now, that's a very nice overview level of how these things work. But again, our physician clients often say to us, would a charitable trust work for me? How do I know? Can you maybe kind of walk through on an overview level, like you did with the Roth conversion, an example of, how we crunch the numbers to see if a charitable trust would work for them?
Yeah, I'm going to once again do a quick share here of a example of what this could look like for someone. The situation, like we mentioned, you're really looking from a tax perspective, an ideal asset to gift to this sort of trust. So let's just say you have an investment property. It's not even a stock. It's a rental that you had purchased a while ago, and now it's trading at a much higher value because real estate prices are much higher. So let's say that value's at 500,000 now, and you had originally purchased it at 200,000. And let's say you're in your mid 60s, looking to set up this type of trust. In this case, we're setting up a charitable remainder unit trust is what it's called, for a 30-year period. So you're looking to collect income on this trust now, get a tax deduction now, gift this asset into a trust, and potentially sell it in the near future without having to pay taxes now. So a really kind of double tax benefit there. And in the meantime, collect income and then have the remainder go to a charity of your choice. So there's a lot of numbers on this page, but just to give you a sense of the magnitude of potential tax savings on this example, $500,000 rental property that you're contributing to the trust, you might be avoiding capital gains taxes at the federal level of around $45,000 in this example. You might then be getting a pretty sizable upfront tax reduction of $168,000. And that can equate to pretty meaningful tax savings depending on your bracket. In this example, we're just assuming a 25% bracket, and that would result in $42,000 of savings. So combined, you could be looking at $90,000 of savings, and then over time, you're going to be collecting income from this trust, and that income might not be too different than if you had just sold the asset and reinvested it and paid taxes. So over time, you might be collecting income that's very similar to if you had done nothing and didn't participate in the strategy. And then, at least in this case, you're going to also maximize the amount you're giving to charity at the end of the day. And in the case where you don't use this strategy, either nothing goes to charity or potentially less even goes to charity because you're not using a tax strategy like this. So a lot of moving parts on this diagram, but that just gives you a sense of how much money we could be talking about.
Excellent. Yeah, there's a lot of moving parts. But if it were easy, then a 3-year-old could do it. But that the tax rules are very nuanced. Investment rules are very nuanced. How much you can deduct for charitable giving is very complicated, and that's why it definitely makes sense to work with a professional who's very well versed in all of these different areas. Lastly, on the gifting of assets side, I know you've mentioned in the past a vehicle called a pooled income trust. And I know maybe this is, you can make a better analogy than I can, but is this kind of like a sibling? How is this similar to and different from the charitable trust you've just spoken about?
Yeah, I think very close relative, Mike. So not too distant relative to this charitable remainder trust is really the one that it's very closely related to. And in reality, this can vary across charitable organizations, but the structure is very similar to a charitable remainder trust. You are donating assets to this pooled income fund to help get an upfront tax deduction and avoid gains on an asset. And then you're collecting income along the way for a certain time period, maybe it's your lifetime. And then at the end of the day, the charity is going to, keep whatever's left in there after all that income's paid out. And this is actually probably less administration involved than a trust strategy because the charity handles so much of it. So whether that's, the Red Cross or, your university that you attended years back, these different organizations run these pooled income funds that you can contribute to, and they handle kind of the year-to-year calculations, which is something you would need to do or hire someone to do in the charitable remainder trust, but it can still be worth it given the, magnitude of dollars you might be saving. It's just, another good consideration if you're looking to get a tax deduction now, some income, and then leave something to charity.
Right, a lot of different tools, a lot of different rules for those tools. And so it gets a little bit complicated, but like I said, you work with a financial professional that knows it very well, can kind of be your guide to those savings or taking advantage of those opportunities. Changing the subject, just thinking about right now, we might have some physicians, the markets are very volatile. Interest rates are now going up, although they've been low for a very long time. Sometimes some of our physician clients have sometimes significant amounts of cash on the sidelines. Just wanted to get your thoughts on what are some potentially good ways to deploy this cash now that we're in a more rising interest rate environment?
Yep. And once again, we could easily do another session for this, right? But just to give like maybe a couple of considerations, like you said, interest rates are rising. And then we are also talking about this in the midst of even like a really, pretty meaningful downturn in the market. So there might be opportunities both on the stock or equity side of things, as well as the bond or fixed income world. So some of these, what we'd consider safer assets, are paying much higher yields, like a treasury, for example. A 10-year treasury, we're getting closer to probably around 3% of a yield that you can get, which is way higher than it was just a year ago. And then we have, stock market, where certain areas of the stock market are trading further down than others and might be better value than others. But in general, we have a situation where probably things like alternative assets should be considered at this time still. For example, something like an infrastructure fund that invest in things like utilities and toll roads and railroads. These types of investments really kick off a lot of income, and usually this income is inflation adjusted because your utility bill goes up if prices are going higher. And similarly, if you're a renter, or if you're investing in real estate, typically real estate rents and income go up. So real estate is like another example of an alternative investment that can be considered in a diversified portfolio. And then just, while we're on this subject, I'll just mention, maybe it's not all about just finding investments, but finding accounts to put money into. So to the extent you can, maybe now's a good time to accelerate some of those retirement account contributions, like 401k contributions you could be making. So, while prices are lower, maybe there's more opportunities than there were a few months ago. To the extent you can, getting those deferrals into pre-tax or Roth accounts could be a great time for that.
Excellent. Thank you very much. I think it's very helpful. Now, I think I'll just ask one more question. And this is actually a question that's coming from our physician audience. Very timely. We're talking about rising interest rates, people trying to get more yield with a good degree of safety. iBonds have been in the news a great deal. So I think I've seen like 20 articles on iBonds in like the last 3 weeks. So maybe it's kind of like they were slumbering, not getting the love that they deserve when interest rates are really low. And now that the deluge of the rain has come, and now they're like shooting up in terms of popularity or interest. Can you tell us like what's an iBond in general, and just what are your thoughts on them, whether it's good or bad, the pros and the cons?
Yeah. Funny enough, I just got a question about iBonds today from a client. So yeah, this is certainly top of mind. You probably see some yields mentioned in the news. I think the recent one that was mentioned was 8.5% for the next year. And these are all, good headlines for sure. But I think sometimes the nitty gritty details aren't given enough attention. And I think, the pro is this vehicle provides protection against inflation. That's what it was designed for. So you're getting a CPI return essentially, which has been very high. So inflation has been higher. So the return on this vehicle is going to be higher. But it's certainly not a free lunch. There's liquidity concerns here. So the minimum investment period or holding for this type of a bond is 1 year. So there's really not much of an option to get out of it in less than a year, which I think is a pretty big downside for many people. And then not only that, if you decide to get out of this bond between 1 and 5 years, you're going to forfeit the last 3 months of interest on it. So another consideration there that, it might be an attractive yield for a 1 year period, but maybe 1 year from now, it's really not offering you much. And now if you want that money, you're going to have to forfeit the last 3 months of interest that you have earned. So those are some cons, but yeah, I think pros, if you do have the right mindset, the right timeline, earning a decent return right now on what we'd consider a very safe vehicle, it's great. You do have to remember that this is a real return of zero. That's what it is, because it's only providing you inflation protection. It's not building any other return in there. It's not offering you 2% above inflation. It's giving you inflation plus zero. So I think that's sometimes something people forget.
Excellent. And also, how much, if someone was very interested, how much can people invest in these things? Can our physician clients say, oh, that's a great idea, I want to put $200,000 into some of this?
Yeah, yet another important limitation that I had skipped over, so appreciate you asking it, is that the max that an individual can put into this is $10,000 if you're investing online. There is this extra opportunity to invest an additional $5,000 come tax time with your refund, but then they mail you a paper certificate, and maybe that gets lost. So not really something a lot of people consider doing. But if you invest for yourself, if you have a spouse you invest for, that's double, so that's 20,000. So maybe it adds up a little bit, and then maybe next year you invest again, or maybe your kids invest too. So there are ways you can get more into this type of investment, but for a large portfolio, the limitations around the amount you can invest and then the liquidity of it just definitely make it a more difficult investment to try to actually manage.
Excellent. Yes, because sometimes you see the headlines in the media, and it seems like it's the greatest thing since sliced bread. And like you said, it definitely has some pros, which we don't want to discount by any means, but it's good to be aware of the limitations as well. So that's what we like to do. We're fiduciaries. We're completely transparent. We want to tell our physician clients, these are the pros, these are the cons. We recommend this, and then they can decide to go with it or decide not to go with it.
Yep, exactly.
This, Ryan, has been, I think, a really excellent conversation. We've covered a lot of ground, and I really like the idea of the topic in terms of financial strategies to take advantage of down markets, because when people think of down markets, of course, they're down, so people aren't that excited about. Everyone wants up markets. Up markets get all the love, they get all the attention. But it's kind of like, there are opportunities in down markets, and people tend to forget that. And it's kind of like making lemons into lemonade. So I like this because we are a little bit more of a contrarian firm. We are very independent thinking. We set our own course to find value wherever it is, and knock on wood, over long periods of time, are able to, do nice things for our clients. But I definitely like the idea of looking at things that might not be that looked at and taking full advantage of them for our physician audience.
Yep. Yeah, I agree completely. I'm glad we spent the time on these topics, because I think it can be nerve-wracking during times like this, but it's great to focus on what you can control and take advantage of the situation as best as you can, even though it can definitely be scary to witness markets like this, where day to day you see some major fluctuations.
Well, thank you again, Ryan. I think you've given, like I said, our physician audience so much to think about. It's really been value added. So I just want to thank you so much for being on today's program.
Of course. Thank you for having me.
If you'd like to talk about the strategies explained in today's video, receive a complimentary review of your investment portfolio, or discuss any of your other personal financial planning areas with an Altfest professional at no obligation, please contact my colleague Jesse Freeling at 212-796-8732. That's 212-796-8732. Or by emailing Jesse at his email address, which is in the description of today's video below. If you like today's video about providing insights to help physicians optimize their personal finances, please click the subscribe button below and hit the bell icon so you can receive notifications each time we release a new video. If you think that a fellow physician would find this video interesting or useful, please share it with him or her to help them. Lastly, as always, this channel is for you, and we want to make it as useful and as enjoyable as possible. If you have topics you'd like us to cover, like or dislike certain things that we're doing, or have any other feedback, we'd love to hear from you. So please share your comments in the comments section below, and thank you very much. Well, that's all for today, physicians. I look forward to being with you again in our next video. And until then, be well, and remember to keep optimizing your finances, or let us help you if you'd like. Thank you very much.